Hello, I'm the Augur, and the channel is TQFM Trading Strategies. I trade stocks and options and make content to help you take your own trading and investing to the next level. So if that sounds awesome, make sure to like the video and subscribe to join my little growing Augur army and help us grow, take over the entire world with future talent. Starting out in trading is really tough. I remember exactly how hard it is to learn how the market works and how to use all sorts of technical indicators to understand price action and market structure. You can spend days and nights just staring at the market trying to understand it, pulling out your hair. And this video is for you to help you understand exactly how that market works and help us all become better educated traders and investors. So in order to do that, we need to understand the math behind the market, the gearwork that makes it tick, and how to read that through the use of math and indicators. All this math is specifically designed to peel back the mystery behind price and the markets and help us understand what market makers and algorithms are doing to move price around and target you and other retail traders. So make sure you watch all the way through the end so you fully understand everything we're going to cover today, so you can learn as much as you can to help better defend yourself from everyone who's out to get you. So in this video, we're going to be taking a look at how to use a Double Ichimoku for either scalping or some sort of swing trading. And you can use it on the 1 minute chart, the 5 minute chart, whatever you want to do. It basically is just using the fractal patterns that are present in the market to better understand trend and make decisions based on that. So what we're going to do today is we're going to talk you through how the strategy works, how to set up the indicators for the strategy, entries and exits for both bulls and bears, and we're going to do a little bit of back testing to see how it works using real market data to see if the Double Ichimoku strategy is helpful and useful in today's marketplace. So let's get going. So this strategy is actually quite similar to a lot of the other strategies I've shown on this channel, where it operates on a sort of trend inside a trend function. But the Ichimoku is a very interesting indicator, which has several trends inside of it already. So it already does a somewhat decent job of displaying the sort of fractal pattern I look for in the markets. And this is just deviation over time. It can deviate a little bit or it can deviate a lot. In either way, it always reciprocates back to a mean over time, because that's just a function of mean reversion and moving averages in general. It doesn't mean that it's going to be higher or lower when it gets back to those means. It just means it's going to get there eventually. At least when we're talking about the shorter term charts. If you go out to like a monthly chart or a yearly chart, it doesn't actually have to get back to the moving averages. Inflation, growth, other things, keep it far away from those for, well, ever. You will die long before it gets back to a 1,000 year moving average, I bet, but who knows. Anyways, back to this. The way this strategy functions is similar to a lot of other ones. We're looking for it to, well, the way the strategy works, let's break down how the indicators work first. You're going to have two Ichimokus. The first one you're not going to touch. It's just going to be your standard settings, conversion line of 9, baseline of 26, a leading span of 52, and a lagging span of 26. I usually turn off the lagging span. The second one, the slower one, is just going to be twice as long. You have an 18 conversion line, a 52 baseline, a 104 lagging span for the B length, and a lagging span of 52 for the initial. And I go ahead and turn off that lagging span and some other ones for the slow one, so because those are actually just going to sit on top of the other lines, so you don't really need too many other lines. What you really want to look for is you got these two fast lines here, and then you have these two slower clouds. When the fast lines break below both clouds and price is trading below both of those, you can look to take a trade in that direction. You can use the clouds as your stop, and what you're looking for is a fractal exit. And let me explain how that works. You see, you have a bunch of lines here, the blue one, the red one, the greenish one, and the orange one. And those are all going to be the ones that aren't part of this white cloud. So if you're using the white cloud as the stop, that's your exit. You want to be taking profit on a faster fractal of some measure. So watch what happens. It breaks down below this and the trend is continuing. This fractal line, this mean reversion, is going to push, push, push. And then it kind of makes this little, basically it's making a trend right as it goes. And then when this orange line encounters price, that's usually my exit on a fractal trade, at least a trend trade. This one didn't work amazing, but it's just an example of a bearish trade. A lot of them do work great. And really, all this is about the risk to reward. You can get a really tight entry with a little bit of risk and a decent play on it. The idea is, well, hopefully you get a decent, you're looking further back to optimize this with some sort of support and resistance or something like that to get better entries. But worst case, you can always use the fractals. So let's look at some more of these fractals. So let's look at a couple more of these fractals. Let's look at the next one. It comes up, it's like you stopped out of there or you didn't, either way. It comes back down here, it gets back up into these little lines here. Let's say you're going to take another trade. So you're going to take a short again, your stops are going to be above this cloud, and you're just going to let it trend. And you're going to see let's use the orange line here. And you can see the orange line working its way along. You can just drag a line, just keep dragging that line. Just keep dragging that fractal line. And it's going to get all the way down here, and it's going to hit price either here or down here. And that'll be your fractal exit. See, you entered here, you started tracking it at literally the same price, and you just dragged it down the entire way. Let's look at this trade to the upside. It comes and breaks out of these. You can take a trade anywhere in here with a stop down here that's about 3-4 points. Then you're going to follow it up here. You start drawing your line. You start drawing your line, following the orange one or the green one, or following the orange one in this case. Drawing your line, drawing that orange line, drawing that orange line, drawing that orange line. And somewhere up in here, it smacks the orange line and it cuts you out. And you see that's a really good trade. It took, maybe 6 points in risk, and you made 18 or so. So there you go. So some of them have really good risk to rewards, and even some of them that don't work, like if you look at this one here, it definitely didn't work, right? Come in, you breaks out, wait for it to get back in between these two lines, take a trade, you're looking down here at like either the green one or the red one. Let's use the red one, we've been using the red one, so, and track it along, you're hoping it goes up, and it just doesn't. So somewhere in here, there and there, you take your loss, and that's still a very small trade. It's honestly, it's the bars that break it are like almost touching bars that touch your entries, so it's almost the same price. And it actually saved you, if you think about it, taking your loss there versus taking your loss there, it saved you a point or two. So when you're only taking a couple points in risk on these sorts of trades anyway, saving a point or two on taking the first fractal versus the other fractal. Alright, and to test out the Double Ichimoku strategy, I've gone ahead and set up a back test on Ethereum. So we're going to go ahead and run 100 of those, and I'll be right back with you after the quick little montage. And I'm back with the back test. You can see it performed pretty admirably. We took 100 trades. We had 36 winners. We had 64 losers. So we had a 36% winning percentage. Our average win was $46. Our average loss was $12. So that's about a 3.75 reward to risk ratio. It took us about 12 days or 4,600 bars. That could be a quite large annualized leverage return. Granted, it doesn't go bust. You can see it had some big winners and then a bunch of little losers. And it's kind of how it looked like in the beginning and kind of how I explained it. So it did sort of how we expected it to do. But it was a pretty trendy market over the last couple of weeks where we tested it. So it might not perform as well in a choppier market. That being said, make sure to backtest it on your own time frames and tickers to make sure you've learned everything you can about this strategy to help you in your own trading and investing. Alright, thanks. Glad you. Well, thanks for watching. I hope you enjoyed it. If you like that, you'll like my other ones on my channel, so make sure to check those out too. And I hope you have a wonderful night. Bye.